Hello TikTok traders! Today we're driving into a topic that can affect all of us, short-term deflation and long-term inflation. It's essential to understand this possibility, so let's break it down in simple terms. Short-term deflation is like a dip in a roller coaster, can be a bumpy ride. But when a recession hits or the economy slows down, we might see prices dropping. But here's the twist. To combat this, we will end up printing more money and taking on more debt. That is where yield curve control comes in, YCC. In Japan, they are the kings of YCC. YCC is like a magic wand that can turn all that credit bubble into inflation. But wait, there's more. Brace yourself for some more fiscal abuse. Massive fiscal deficits might be needed. And of course, the Treasury will print more debt and the Fed will monetize that debt, growing our already massive debt exponentially. Now, the big question, will we ever see 0% nominal yields again? Well, it's like predicting the weather, but in my view, it's unlikely. Let's say I think 2% could be the floor for nominal yields. So what does it mean for your investments? Think of it like driving a car while only looking in the rearview mirror. If you're betting on rates going all the way down to zero or even negative, you might miss the big picture. You see, with inflation rising in the long term, it could act as a safety net for yields, setting a floor around 2%. This might limit the potential for big gains through rate changes. Remember, old Wall Street wants their bubbles back. They want 0% interest rates to push more asset inflation so they can sell you more products and collect more fees. If you want to grow your pile, pay attention to inflation and bond yield. Remember, you gotta risk it to get the biscuit, baby.